Our next presentation is the working class multifamily market approaching its Goldilocks moment. Our presenter today is Tony Barkin, founder, CEO, Allagash Partners. Tony?
Hi, Tony. I'm going to stop sharing my screen. Are you ready to project yours?
I am, yes.
Okay, here we go.
Okay. There we go.
Perfect. Thank you, Tony.
Sure. And thank you. And thanks everybody for, being here virtually. It's a little strange chatting to an empty room with the presentation, but hopefully you'll find it interesting, and I look forward to your questions. I'm going to move through a lot of stuff pretty quickly, so happy to share the presentation if you reach out and would like to see it. Just in case we go past something. There'll be a bunch of data at the front end. My goal for the presentation is to do an update on the multifamily housing market in general, and then to really getting down into the numbers and into how we've seen performance on the ground, and then to kind of step back and take a wider view of a trend that has existed pre-COVID that we think is the major driver of value in the marketplace, and how to take advantage of that. So with that, there's our disclaimer, lawyers don't let us the update. Yeah, I think we can't really do an update without looking back and seeing what our expectations were at the beginning of this COVID process. And certainly the matchstick moment, the moment that we were all really concerned about and waiting on was jobless claims. And we saw something that really has never been seen before by a long run. It's not like, besting the long jump record by 4 inches. This is like jumping out of the stadium. And so we saw jobless claims spike. We're still seeing them spike. They continue to be larger than we've ever seen before, not to mention en masse. And so the follow-up from that, obviously, we talk about the real estate market, the 2 public markets that people look at are the credit markets. And we obviously saw right after that, that event, or the beginning of the COVID event impacting the economy, we saw bond yields, credit bond yields spike up, while obviously the risk-free rates were going significantly lower. So spreads were widening. At the same time, we saw the S&P, and this goes all the way back to 1986. For those of you like me who can remember the 87 crash, it actually is that little drop off at the very beginning of the graph. And that was actually peak to trough about 35%. And we saw almost that amount. We saw about a 30% peak to trough in just a matter of days as a result of this. And it's just been the fastest move, the most volatile market that we've seen. Obviously, this graph, not that there's any surprise because we all live in the real world and know what's happened. This graph shows that we've bounced back from that, and right now we're right back where we started, basically. And on a comparative basis, this move happened in a matter of days versus it taking months even after the Lehman crisis. So it's been a most volatile market. And the question became, for commercial real estate, is that going to, and with multifamily, how is that going to filter through? And the leading indicator for residential and multifamily properties is the traffic index. Traffic is the number of people who are coming to look at a property at any point in time. And we saw a massive downturn. A 10% drop in traffic is considered a very significant drop in traffic. And as you see from this, in the weeks that followed the onset of this COVID pandemic, we saw a 30 to 40% drop in traffic. So people were not coming, certainly they were not coming to look at it. And it really became a question as to what was going to happen here and how are we going to move forward. Obviously, we now know that traffic bounced back. We've seen it, it came right back. One of the things that this indicates, and the traffic is the measure of new guest cards, but it's both in person and virtual. And what we've really discovered is that the virtual systems that have been built up over the course of the last, say, 5 years have really gotten to the point where we are seeing actually very little hiccup in renting. And I'll get to actual occupancy vacancy in a second. So this was very good news. Obviously, it had to carry through into payments for the people that were actually living in the houses, living in the apartments. And so what we see here is that when we compare 2019 to 2020 for the months of the pandemic, I should unfortunately say so far, what we see is actually a very small drop, really marginal. We're talking about a couple of points for on-time payment. And as you see, this on-time payment is defined as payment over the first 6 days of the month when your rent is officially due. It tends to run at around 80%, just above or below. And basically, we've been there. Slightly lower. I mean, no question that over the course of 4 months, if you're running a couple of percent lower, then we can say we are a couple of percent lower. This is not just numbers and variability. We are a little lower, but it is a little lower. Not a tremendous amount lower, although I will talk about the outliers a little later on. What does that mean for total payments? Because at the end of the day, we only get between 80 and 85% of our payments on time. The balance come in throughout the rest of the month. And you'll see that in general, we run about 96%, 97% in total payments for the industry. And over this period of time, we've been running 95, 96%. So again, a couple of percentage points below, obviously a little bit delayed in the payments, but not dramatically, not so much. Year-on-year payment rate was down 0.1% in June. And that, I think, is a very good statement. And I'll talk about, why we think that happened a little later on as well. Moving through, obviously, what then matters is occupancy. And, if we've got people coming into the property, we've got the people in the property who are paying generally as they have been. The question is, are we going to have a massive change in occupancy? And that became a question. People were talking about themes. Everybody likes to come up with a storyline. People were talking about people moving in together. They were talking about people moving out of multifamily apartments and trying to move in with family in houses and other areas. And certainly, I think that those are rational discussions as to whether they could happen over the long run, but we didn't really see much of it. Without question, move-ins are down. We see that and significantly down. I mean, if you were to only look at this part of the equation, you would say, well, that must mean that your vacancies are picking up. But in fact, move-outs are down almost as much. Not quite, and we are seeing a little bit of a change in the vacancy rates. We're starting from record levels, however. The Q1 of 2020 ended with a 6.6% vacancy, which is the lowest since the second quarter of 1985. So, well, actually it was slightly higher than the 6.4% seen at the end of 2019. That was actually the lowest. So it was slightly up, but basically we're at rates that we haven't seen in over 30 years. and in terms of occupancy. And I think that this is unlikely to change that, which we'll talk about now. I mean, the question becomes, why is this happening? Why are we in a point where, given unemployment and given obviously the pandemic, that that multifamily is performing so well, really, as an asset class? And I think that the answer is in two parts. The first is that the stimulus is working. There was a University of Chicago study that analyzed the CARES Act, and it determined on average that it was going to allow for a dollar for dollar replacement of lost income by US workers nationally, which was terrific. And then without judgment, it went on to say, however, the median replacement is actually going to be 134%, which means that the average, the median worker is actually going to be receiving over what they were receiving from income from working. And in fact, the number is 68% of American workers are taking home more money now than they previously earned. And 20% are taking home 200% or more of their earnings. There's very significant deviation by state and industry here. However, those numbers really do indicate that there is cash available for people to pay rent. The question becomes then is, do they pay rent? Is that something that's important to them in a world where you're concerned about cash? Are you paying rent? And there's been a theory that in fact people are using their credit cards to pay rent. They're building up significant debt. I think that this study by the University of Chicago really allays that fear. People are using credit cards more to pay debt, but it's really for an ease of payment rather than, in many cases, the rental offices are not staffed fully. There are obviously payment boxes that people can pay in, but it's just easier and to a great extent, more economic, as people can actually generate points in their various credit card systems for paying. And so we are seeing a significant uptick in credit card payments, but I don't think that the performance is a matter of people building up debt. In terms of just, do they want to pay? There was, another study by Brookings that talked about people living in poor quality, overcrowded and unstable housing, or without any home at all, are at significantly more risk. And I do think that in general, certainly when we talk to our renters and we talk to generally people in the industry, housing is a more important feature in life today than it has ever been. I think people always treated housing as something that was extremely, valuable to them. In some cases, however, the perception was that people were taking it for granted. And I think now nobody is taking that for granted. And I'll talk about, the majority of renters, with the working class renters, and our experience with the way in which they treat their homes. But what we know is right now, even with evictions on hold in most of the country, the average renter does not want to put themselves in a position where they're going to be evicted or where they build up an issue. We'll look at their balance sheet in a second in terms of their ability to pay and their ability to pay back due, and it's not good. And so renters know this, and they're trying to stay current to the extent possible, and that's absolutely seen in the payment numbers. On the other hand, now we've got to talk about the value of properties. We were seeing significant rent growth over the last few years. As this chart points out, we were showing rent growth that was, the 2 to 3% that we would expect. Rent growth for this year through June now, while it was on pace to be on trend, is now basically unchanged for the year. And when we divide it by regions, what we see is that 5 out of 10, half of the regions around the country are actually down since the pandemic began. And so, we are not seeing positive rent growth. That's obviously, we talked about the value in terms of the cash flow, but now in terms of the value of the property, we've got to look at cap rates. And with income basically stagnant, what's happening with cap rates? Right now, what we're seeing is the cap rates haven't moved. But cap rate movement is really, to the downside, is really about seller capitulation. And this has been, as a number of people have talked about in previous sessions, this is as a kind of a black swan event that everybody hopes is going to be a finite period of time, albeit, unfortunately, I think a fairly long period, a longer period of time than we would all hope. Cap rates haven't moved because we haven't seen any seller capitulation. And as the previous panel talked about with respect to distressed opportunities, there hasn't been a significant amount of selling by distressed owners. And we're not seeing a significant amount of transactions for non-distressed. And that's obviously in the deal activity. Here's the April deal activity. And we see that it's down dramatically. There are sectors now like hotels where the volume is zero. And in many cases, the volume is pretty close to zero for things like retail and some of the other industries that have been affected by COVID. So I don't think that statistically we really have a fair view of where things would trade today were they to have to trade in volume. It's great to say that we're stable, and I think certainly it makes everybody's portfolios look better and people feel happier. But I'm not sure the news is quite that good, despite the fact that the cash flow news and the underlying fundamentals are quite good. So then the question is, has this crisis passed? And 2/3, this quote from Bloomberg, I think is extremely informative. In the largest housing market, which is New York, where 2/3 of the people rent their houses, we've seen significant jump in unemployment, not unlike any place else, everywhere else in the country. But we've now seen a quarter of the city's renters not having paid since March. So that's a very different piece of information than we were seeing from the national numbers. That now you've got an area where 25% are not paying, not 10%. That's a dramatic change. So what is it? What's going on? And I think that what we can look at is the price change by city. And it's the chart on the right here. The nice thing about presenting this way is that I don't have to ask if everybody can see it. I'd have to make each of these their own slide. But basically, if you look here on the right, you'll see that the largest dots are in blue. Those are negative price changes. I think that what we're seeing, people have described the pandemic as an accelerator for trends. And people have talked about retail and online retail. They've talked about telecommuting. They've talked about these trends, and that the pandemic is really serving as an accelerator for those trends. I think that's true, but I think it's also an illuminator of other trends that we haven't been talking about or have been a little bit on the back burner, and really also some crevices in the general economic system. And I think that within real estate, where it's illuminating is that the areas that people have perceived as the most stable, as the place to put money and it'll be fine, the larger metropolitan areas, the more expensive class B plus and A minus and A properties, which have been trading, as we know, at really expensive cap rates and expensive pricing in general, is something where that's actually looks today to be more of a risk. If you look at the places and the size of the dots where you've still got positive growth, there's no question that some of that has to do with the flow or the spread of the disease, but there are plenty of areas and overlap here where you can see that the smaller dots are actually still having upward price movement where the larger dots are not. And I think that that's really the risk. Over on the left, you see the areas that are the 5 most expensive states on rent per square foot and the 5 least expensive states on a rent per square foot. And you can see that rents are, as we go from the least expensive to the most expensive rents, they're double or triple on average. And obviously, there are major sections of the expensive groupings where it's significantly more and multiples of that average. So I think that there are assets that are really at risk in this pandemic and as a result of the economic upheaval that we're going through and are going to continue, I think, to go through for at least a reasonably significant longer period of time. Which takes us, in fact, to discussing and moving back up in the few minutes we've got to the housing issues at hand and why I think this is a Goldilocks moment. Let's talk about, so what we're really going to talk about is working class rental housing. And we break down, and as I said, I can send you this so that you can see. We break down the world into 7 groups, with the working class being by far the largest group, more than double the amount of any other group, an economic tier. And soon we believe to be more than half the country, if demographic trends continue and economic trends continue. So this is a huge portion of the country. The working class is not only the largest portion of the country, it's also the least supported part of the country. And by that, I mean that the economy, obviously for the upper classes, the savers, the affluent, and the independently wealthy, the economy is their support, or their current situation is their support. And for the lower classes, there is subsidy that's available. But for this part of America, for this slice, it's the least supported slice, economic tier in America today. I said I'd talk about what their balance sheets and income statements look like. And we're going to do it in the context of why these families need to rent. If we look at the price of an average house, it's $227,000. The equity required is about $58,000 today. A 4-person family has a median income of $76,000. And when you break it all down, they've got about $1,000 annually, not monthly, not weekly, certainly not daily. They've got about $1,000 annually of disposable income. They're not going to get to that $58,000 now. It's just not going to happen. I think they recognize it. And if we take that knowledge back to how working class renters treat their houses, we talked before about how housing is more important. If we take this back, what you get is the understanding that for people, their rental apartment is truly their home. And that's what we found. Over the course of myself 15 years and my partners 20 and 30 years working in working class rental housing markets, what we've found is that the working class household is treating their apartment, their rental unit, in a truly home fashion. And that is different than we're seeing from the other economic tiers in the way they treat their homes. So we actually think that it's not only from an asset standpoint, it becomes a really well protected asset by the people who are occupying it, and that's an important feature. Let's quantify this. 6 million is the number of households that are now experiencing some form of affordability gap. And that's really the combination of building costs, equity requirements, and the rental rates that the working class and below can pay. And as a result of those 3 factors, it's very difficult to scalably develop, profitably develop working class housing. You can develop it. On average, the way the math would look if you were to invest equity in these properties is that on average, it would look like basically making treasury returns to take development risk, which obviously is not a calculation that makes sense. And so what we've seen is that while there are definitely projects that go on, that we're really not filling this gap. In fact, if you look at the bottom, the current trend is that for every new unit that's coming online, 2 units are being lost to age and neglect. And to give you an idea, if every single family home and multifamily unit being built today were to focus on filling this gap of affordable housing. And again, we're not talking subsidized, we're talking market rate affordable. If we were to use all of that, it would take 5 years. If there were no loss, it would take loss from age and neglect, it would take 8 years, given the current trend. And obviously that's not what's going on. We're not only not making a dent in the 6 million, it's becoming worse. And it's a national problem. The affordability gap exists throughout the country. This is not a local or regional issue. It's a national problem. Why is this a Goldilocks moment that's approaching? Well, I think it's worth looking back a little bit. The working class multifamily housing sector was one of the best performing sectors during the financial crisis. It had, as we're seeing now, a very small change in cash flows underlying the properties. So NOIs at the property level didn't change dramatically. It came back from a value standpoint as a result of that extremely quickly, faster than really any other real estate asset class. So you've got this great history of having performed well in a crisis. We've got the intractable nationwide supply-demand imbalance. People work every day to find small supply-demand imbalances in stocks, and we've got one that's not going away. And is as large as any supply-demand imbalance in the world. By the way, supply-demand imbalance here is another word for crisis, or another term for crisis. So you can, when you think about it in terms of the social standpoint, it's a crisis. When you think about it from the economic standpoint, which is the other side of that coin, it's a supply-demand imbalance and an opportunity to invest. Simultaneously, it's a real asset inflation hedge. And it's one that's an income generating asset. So as opposed to so many inflation hedges that just sit as a lump on your desk or somewhere else and cost money in order to maintain, this is an income generating asset. In fact, the income is indexed to inflation, so that as I expect, we get significant inflation post-pandemic as a result of wage growth, followed by general inflation, then we're going to have significant rental inflation. And so that'll fall to the bottom line for these properties. It's a low volatility, low beta portfolio diversifier with significant scalability. The working class housing market is equivalent to the healthcare sector market capitalization. I just read that from the bottom, but it's a fact that people don't think about. Just this small sector, and it's not small, it's a multi-trillion-dollar sector, is an underinvested sector. For every equity manager that exists, let me phrase it, for every commercial real estate manager that exists, there are 10 equity managers. It is underweighted across the board in people's portfolios. I really am running out of time, but we are launching our newest fund. It is similar to our current fund. It's our second fund. I'd be happy to talk about who we are, who my partners and I are. The fund is an opportunity fund that focuses on exactly the opportunity we've been talking about. It looks at it in 3 ways. It renovates properties, buying underperforming properties, renovating them and managing them. It does adaptive reuse. We convert uneconomic properties. Some of the other panels have talked about hotels, especially in this situation, and we are actively working with investors and looking at deals right now. We have one on our plate that we're doing, and then development. While I talked about the fact that development in general is uneconomic, there are strategies, and one of which we've developed, which is a little bit of a niche strategy, but we think is very helpful. It actually works with veterans and their ability to borrow from the VA. If you're interested in veterans, and working with veterans. This is a really great program, and we're just in the process right now of doing the first of these developments in North Carolina. We've got competitive advantages. We've got a very clear and direct vision. We've got my partners and I down at the bottom are over just the three of us are over 100 years of experience in commercial real estate, with particular and extensive experience investing into and managing working class rental properties. So we've got tremendous opportunity access. We've got a large pipeline of deals. This will be a standard opportunity fund. So obviously we're going to raise the money and then invest it and call it as we execute and negotiate each deal, which I think is preferable in today's world, because I do think, as I said, relative to the cap rates, that prices are likely to weaken a bit. I don't think they're going to crater in multifamily, but I think that we're looking at prices in general, because we're talking about secondary markets. Again, we talked about this earlier, which I think are opportunistic. We're talking about more granular, smaller transactions, which again are opportunistic. So these are assets that really haven't rallied with those shiny, new, large market assets that are trading at such tight cap rates. We're able to buy at 6 to 8% cap rates pre-COVID. So we think that's opportunistic. We've got an established process that we've put into use for years, and we have community engagement. Sorry, I'll go back to that for 1 second. We have active interaction with our communities in order to make sure that we are actually working with them. What we see is that when we work with a community actively, what we get is actually an increase in return and a decrease in risk. And I think that there have been, I would go through it, certainly the Amazon transaction in Queens was a recent one. I think this is a big competitive advantage. It is neglected by many people. It is not thought of. And there's a lot of research that says that this works out well. And there's obviously a need. And again, it brings back the social aspect of the crisis with the opportunity aspect of the supply-demand imbalance. And it really is an opportunity to do well by doing good. We feel that very strongly. That doesn't mean, by the way, that we don't think that doing well is important. We project for this fund high teens net returns for investors over the life of the fund. So we're very optimistic that this is significant. This is actually the beginning of the launch of that new fund. And be happy to talk about people, be happy to send people this presentation. Unfortunately, I didn't leave a lot of time for questions, but I'm happy to go online and answer them either through email or through the chat that's available here. I'm sure I'll catch up with those in a second. I very much appreciate your time, your patience, and your attention during this. And I look forward to talking to everybody about the market, about the opportunity, and about our new fund. So thank you very much. And with that, I will pass the baton back, having only overrun by a minute or two.
Tony, thank you very much. I appreciate your presentation today. I'm going to take back control of the screen here. Let's see here. So Tony Barkan, we will be putting together a recording of today's presentation, sharing it with all of the attendees, and with your permission, of course, a copy of your presentation. Is that something that would be okay? Because we got a number of people asking.
Absolutely.
Okay.
Happy to share it with anybody who's interested.
So we're going to be doing a follow-up. It takes 3 days at least for us to do the editing and to do the recap of 12 hours of live content. So, but we'll include contact information on how people can get a hold of you.